Thank you so much for joining. Today I would like to spend a few minutes on market structures. Why is it useful to understand market structures? Because they determine how profits are made, what type of decisions management should make, and to really understand the market or the industry a company operates in, it's very useful to understand competition, pricing power, to understand interactions with buyers, with your suppliers, and in the end, what drives return. If we look at market structures, we usually categorize them into four. First is perfect competition. This is the most competitive environment. And here, as the name suggests, we have many competitors. It's really unlikely that one company has higher profitability or profits than the other competitors. These are all price takers, and usually what we would assume, we would call it normal profit, which means those companies competing in perfect competition environments, they would earn normal profits, meaning they would just earn a profit similar to their cost of capital. So it's really hard to make more money or to outperform other competitors, but still there are millions of businesses that operate in a perfect competition, but from a profit perspective, we assume they are quite similar. There's no product differentiation and also no price differentiation. If we go to the next one, it's also highly competitive. It's called monopolistic competition. Here we have a bit of mix. We have many companies that operate in this market, but we still have some monopolistic characteristics, meaning some companies are a bit different, and this is due to product differentiation. So if you look at, for example, soft drinks, many companies, and then you have, for example, Coca-Cola, is a bit different product differentiation, distinct, and can potentially charge a bit more because of brand awareness differentiation, brand loyalty, and so on. Next one is oligopoly. It's a market structure that is based on a relatively small number of firms supplying the market. Some airlines, depending on the routes, they have a bit of pricing power depending on which market they operate in. And this is highly driven by pricing behavior and how other firms in the market operate and what needs to be adjusted in terms of competition. And then the last one is called monopoly, and this is the least competitive market structure. If we have a pure monopoly market, that means there's no other good that substitutes for the given product or service. It means we have only one single company that sells the service or the product. If we have those market structures, then usually those monopolies are regulated by a governmental authority. In most countries, we have, for example, the local electrical provider, where there's only one, and then it's regulated by the government. And we say as well, or from a regulatory perspective, we would allow this company to earn normal return on its investment. Yeah, so otherwise, if it's unregulated, it would be against the customers, and this monopoly could charge quite a high price because there's no competition. There are 5 factors that determine market structure. The first one is the number and relative size of the firms supplying the product or the service, degree of product differentiation, as we said, perfect competition, no product differentiation. As we go through monopolistic competition, you have a bit of differentiation. Power of seller over pricing decision. Is it more coming from the company that sells, or is it more set by the customer because the customer has many different options? Then the relative strengths of the barriers to market entry and exit. How hard is it to get in? Are specific or high initial investments required, or is it like a regulatory entry barrier? And then degree of non-pricing, price competition, such as differentiation, branding, and so on. If we go through the characteristics, so in a perfect competition, we have many companies supplying the product or service. Here as well, many. For oligopoly, we have a few, and monopoly, we're talking about one. If we talk about product differentiation, here we have standardized products or so-called homogeneous products. Here the products are differentiated. Here again standardized. And here we have a unique product. Barriers entry, very low. That's why there's high competition and a lot of firms. Here it's low, high, and here very high. If you think about the local electricity provider, quite high in terms of investments, regulations, and so on. Pricing power, here is none, because the customers have so many options. Under perfect competition, all the products are the same, so it's really based on price. You can't charge more. The company has no pricing power. You just sell at the lowest price possible, and that's why we call it normal returns, because you can't really outperform others or make a high profit. Here we have some pricing power. Here depending some or considerable, and here as well considerable, but because it's regulated, it's usually kept. So those companies cannot charge super high prices. And then non-price competition, here we have for perfect competition, we have none. Here we have some advertisement and product differentiation. Here as well, advertisement and product differentiation. And here it's only advertisement, because product differentiation, there's only one unique product. Yeah, so this is the overview. It's quite useful. There are tools and frameworks out there, Porter's 5 forces, to better understand the market, the industry, which gives you a good tool to map industry characteristics. But usually when you analyze a business or a company, it's useful to understand in which kind of market they're operating in, because there are certain drivers that impact decisions, profitability, pricing, product differentiation, and so on. Thank you so much for listening. I hope you found this useful, and I see you in another video. Bye bye.